further ado, I will ask Beth to take the roll call
Trustee Martin,
here.
Trustee Moore,
Here.
Trustee McMahon.
Present.
That's all I have so far.
Okay, great. So welcome. I'm dressed like a tree today. I'm basically copying our fall foliage because I can't be outside and show you how pretty it is out there. So I'm doing the best I can to bring it to you. And saw most of you just last week, so it was nice to get together. And now we're going to start our investment committee meeting with tab 1. And tab 1, we are thanking Timothy Griffin. He's our non-voting trustee member of the non-voting non-trustee member of the investment committee. He served with us since August 25, 2022. Timothy Griffin was a graduate of USM and is a treasurer of the USM Foundation. He shared his knowledge and experience with us over the years, and we want to thank him for his service to the committee. So without further ado, I'll read the text of the proposed resolution that the Board of Trustees, acting through the Investment Committee, extends its appreciation to Timothy Griffin for his dedication and service as a non-voting, non-trustee member. Do you have any questions or any discussion?
So move.
And can I have a motion? Trustee Moore, Trustee McMahon, seconded by Trustee Moore. And Beth, I'll hand it over to you.
Trustee Martin,
Yes.
Trustee Moore,
Yes.
Trustee McMahon.
Yes.
The motion carries.
Excellent, thank you. And moving on to the investment committee, tab 2, the work plan. This is that time of year where we always go through the work plan. It basically goes over looking at what our charge is, the duties and responsibilities, committee authority, and the membership of the committee, members, and the staffing to the committee. I trust that you've all had a chance to take a look at that and also take a look at our schedule. Do we have any questions or concerns on the schedule and the work plan? In fact, if you look at the work plan for the September meeting, it's right on charge and aligns perfectly with our agenda. So that's, I guess we're doing a good job in that regard. And I guess moving along, I'm going to pass the meeting over to Kelly and Matt from NEPC. They're going to go over the capital markets review and quarterly performance. So without further ado.
Great. Thanks, Kelly. Good afternoon, everyone. It's great to be with you. Kelly Regan here, and I'm joined by Matt Landon. Today we have really 3 items to walk the committee through. The first is going over markets. We're going to be talking about June performance, so we're going to touch upon markets at the end of the second quarter, but we're almost at the end of the third quarter, so Matt will roll us forward a little bit into third quarter results. We'll touch on the plan or portfolio performance for all 3 portfolios as of June 30th. And then we do have one recommendation for the committee as we continue to look at the fossil fuel exposure across the portfolios. And so today we have a recommendation on a core fixed income manager that I will touch upon after Matt's done with performance. So with that, any questions from the committee before we get started? Okay, hearing none, Matt, I'll turn it over to you and I'll share my screen. The other thing is that Matt and I noticed that the materials are no longer being bundled together. So for the next meeting, we'll put page numbers on our materials going forward. So please refer to the screen for what page we're on.
Great. Well, thanks, Kelly. Maybe if we move forward to PDF page 3, that first page we have in here, and I'm going to take you guys way back to the end of Q1 and sort of set the stage here. You may recall, it wasn't a great macroeconomic backdrop coming into that quarter. Q1 was a down quarter, which was the first time we've seen negative equity markets in really quite some time. We came in with unprecedented tariff levels, or announcements rather. There was a number of geopolitical conflicts throughout the world. There was legislative uncertainty with the big beautiful bill. And then the VIX, which is the market's fear and volatility gauge, was spiking to levels that we haven't seen since the great financial crisis and the COVID pandemic. So not a great backdrop coming into the quarter. What we ended up with was the tariff deadlines were pushed back. Some of the most severe tariff policies didn't really materialize. The big beautiful bill was close to completion. And then because of all that, U.S. markets started reaching all-time highs again. I think the S&P 500 you see on this page here for the quarter was up at 10.9%, fully erasing the down quarter it had the prior quarter, with a year-to-date return of about 6.2%. We saw a return of the growth versus value dynamic. So you may recall in Q1, value outperformed growth in a historic manner. That fully reversed in Q1. You see the large cap growth there, up 17.8% versus only 3.8% for the value. And then on the non-US side, those continue to run as they did in Q1, just given some of the improved trade dynamics that we've seen, a weaker dollar, which tends to help non-US assets, and then some physical stimulus throughout the world, particularly some rate cuts in Europe. On the fixed income side of things, towards the middle of that page, up about 1% across the board for the quarter, with the exception of the longer durations. You see the long treasuries there down about 1.9%, just as the yield curve steepened. Fixed income followed sort of similar path, at least from the spread front. Spreads widened in April, but then recovered in May and June for a lot of the same reasons that the equity market rallied. And then throughout all this, the Fed continued to hold rates despite some of the, immense pressure coming from the White House. And obviously we've seen now, and we'll talk a little bit more about it in a minute, but they did go ahead with one rate cut with another, 2 or 3 priced in for the rest of the year. So maybe let's jump forward to the next page and bring us to the latest monthly data we have, which is as of the end of August. So real quick, in July, the equity market continued to rally. We saw really strong corporate earnings come through. I think 80% plus of companies exceeded their estimates. Growth continued to outperform value. The dollar actually strengthened, so that did hurt non-US assets relative to US assets. They were still up for the month and for quarter to date. EM did well, just given some of the Chinese equity market dynamics there. And then we did finally see some trade deals starting to materialize, particularly with Japan and the European Union. So all good things coming in, at least from a market perspective, coming into July and through July. But what we did start to see was some labor market weakness starting to creep in. So the July report came in below expectations, but probably more importantly, we saw some downward revisions for prior months, which actually were the largest downward revisions we've seen since COVID. So kind of going into August, equity markets were still up, as you can see here, especially in small cap, as the prospect for lower rates started to get priced in, and small cap tends to do better when rates are being lowered. We did see continued pressure on labor markets. I think unemployment rose to near 4.5%. And we had more downward revisions. Trump fired the head of the BLS. So we come into the Fed meeting a week or two ago with expectations of a rate cut at near certainty, 100% there. There was a small chance of a 50 basis point rate cut, but as I mentioned, they went with one 25 basis rate cut with the expectation that's more to come. And this is really reflecting sort of that dynamic, and we've talked about it before, but that dual mandate that the Fed has between inflation and labor market, the health of the labor market. As you read through some of the notes, you're starting to see some more comments about inflation potentially being more transitory in nature. Maybe these tariffs are a one-time hit, and not really seeing some of the big inflation fears come through. So sort of transitioning their focus more to the labor market and seeing some weakness come through there really led to that first rate cut that we've seen in quite some time, and likely more rate cuts to come. Kind of more on that dynamic, at least on the inflation front. I want to hop forward a couple slides to PDF page 9 and just talk about the inflation picture that I just mentioned. And what you'll see is that dark blue line, that's that headline CPI number that always gets quoted, and what you'll see come through on a lot of your prices that you go to the store and buy stuff with. That lighter blue line, that's the manufacturing prices paid. So essentially what companies are paying for the goods. And normally these are in pretty good lockstep, but you can see more recently they diverged, which suggests that we are seeing some inflation largely from these tariffs come through, but it's not really being passed down to the consumer just yet. So there's concern, at some point these companies are going to have to push prices down to the consumer. So the concern is that inflation isn't non-existent, like maybe the top line number would suggest, but it's more just delayed. So just throwing that out, there's some dynamics where, a rate cut would be sort of inflationary in nature, but help the labor market. On the flip side, if they were to keep rates steady, it would help inflation, but maybe hurt the labor market. So some dynamics that the Fed's working through currently. And then maybe jump forward 2 more slides just to how this affects our market outlook going forward. Obviously, there's going to be continued pressure rate cuts. They've already done so once. Again, likely more to come. And probably even more to come in 2026 when the Fed chair Powell is and he will be replaced. Trump will likely appoint someone more favorable to rate cuts. So likely more to come there. We see no sort of stalls in volatility, so we're recommending clients brace for that volatility. We've already seen that this year, obviously, with the markets having some historic drawdown in April and then fully recovering, as we saw with the S&P up near 11% during the quarter. And then just given some of the uncertainty around just larger legislative policies that may be coming through. With volatility, we continue to recommending rebalancing to targets. This thing that we've been harping on for the past few quarters, that sort of be boring approach, be disciplined in your approach. When there's chances to maybe raise liquidity to ensure you have sufficient liquidity within the portfolio, do so in a manner that would rebalance back to targets. And we've been working with the team to do that for your portfolios. And then finally, probably one that's more top of mind for you all is this final bullet with the global equity strategies. In times of higher volatility, there tends to be a time when active management can really add value. And the place where active management has the most latitude to go into different places to, really flex their expertise is in the global equity markets, where they have the widest mandates and they can really capitalize on the inefficiencies that they're seeing throughout the world. And we've recently, done this with the addition of Lindsay Train and Impacts, which are, 2 highly rated strategies from NEPC that we feel like would be additive to the portfolio and really align with this bullet point here, in that global equity can be real additive as we move forward. So any questions on markets before we jump into some of the specific portfolio performance? Okay. Not hearing any. Maybe, Kelly, we jump forward 2 pages to the operating fund. Currently about 250 million. This was a slight decrease of about 30 million since last quarter, which were all entirely due to outflows. This, again, is the most conservative of the 3 portfolios, roughly, a third in cash, although we are still in line with targets and ranges. Performance, likely not to see, a ton of alpha here, just given that large allocation of fixed income and cash. So we're performing in line with benchmarks there. No concerns really at the top line level. We do have, I think, 3 manager announcements that we'll talk about in a minute, but no real direct actions related to those. And then the only recommendation we'll have is that fixed income manager lineup review that Kelly mentioned, and she'll be walking through after this section. On the pension, on the next slide, about 16 million, a slight decrease, which is due to outflows. Did see some positive performance there. This is going to be more aggressive than the operating fund, a larger chunk to the global equity that we mentioned. We did add the impacts and Lindsay Train there, remove Mondrian, which you may recall, which was the emerging markets manager, just aligning with that guidance where global managers, maybe a ripe time for active management there. Continue to be in line with targets and ranges. Some of the short-term performance is going to deviate a little bit. More recently, it's been due to some equity managers, particularly Walter Scott, which were a drag over the quarter in the past fiscal year, and we'll talk about that in more detail in a minute, as well as over the fiscal year to date and 1 year time period, being a little bit more defensive with things like Newton. In terms of manager announcements, we have 4 here with no specific recommendations, and then we also have that fixed income manager review that affects the pension fund. On the managed investment pool, about 396 million. This is an increase of about 26 million over the quarter. There was some slight outflows, but a large increase just due to performance. You can see it was up about 7.3%, in line with targets and ranges. This can be a little bit more diversified. It's going to lag slightly over the trailing time periods. More recently, like with the pension, Walter Scott's been a little bit of a drag, and then some more defensive positioning with Newton. The rankings here look pretty good. You can see the 28th percentile over the quarter, but over longer terms, as we talked about in past meetings, going to lag a little bit, just given that illiquidity premium that comes along with the illiquid assets that we don't have a large allocation to within this portfolio. And then 5 manager announcements plus the recommendation for the fixed income manager review. So maybe we'll quickly hit on those due diligence events, the managers on the next page here. Really, I mean, you can see there's no action for 4 out of the 7 here. And then the other 3, there's really no action, but we're sort of maintaining watch. Couple of these like Impacts and Walter Scott, there's upcoming retirements there. So just some well-communicated succession planning with no concerns there, which is why the no action's coming through. There's also some, personal updates with things like Newton. They're just trying to realize some synergies that they have with their parent firm, which is BNY. So no concerns there as they're actually adding resources to their group, to this particular strategy. I know I'm jumping around here. I want to get to the watches here in a second. And the Vanguard is the other one here with, not Vanguard. The Federated Hermes there, there's a leadership promotion with RJ Gallo being promoted to a deputy CIO as part of some long-term succession planning. So we'll likely see that CEO step down at some point, at which point we'll likely have a new due diligence event. So coming back to the middle of the page there, that Acadian, PIMCO, and Vanguard. Acadian, they had some ownership concerns back in 2021. We placed them on watch. However, it's pretty common. Anytime there's a change in ownership, we'll generally put them on watch and just to make sure there's been no change in the investment process due to that ownership change. And I think it's been enough time. We've seen enough good things coming out of that group that we feel comfortable moving them up away from watch and back to no action. And then PIMCO and Vanguard. PIMCO remains on watch, but this is sort of a long-standing one like Acadian. Some legal troubles there, and there's 2 out of 3 complaints that they've had have been resolved, but there's still one outstanding one. So it came up this quarter just because we had another meeting with them, got an update, and just sort of reiterated our watch until that resolves itself. And then finally, Vanguard, there was just some restructuring. They've had a lot of growth over the years. And so they're sort of establishing 2 independent U.S. investment advisors. There's going to be no change in their philosophy, their processes, and their methodologies. And then importantly, no expected changes or impact on the fees or performance there. So it's a firm-wide watch with no real concerns at the moment. If there's no questions, maybe we can jump to manager-specific performance on page 17. Great. We'll take each of these in turn. The managed investment pool, there's a lot of overlap between this one and the next one, or the next 2. The SSGA position, relatively new, in line with the benchmark. It's just going to under or outperform based on how energy is doing. You see that quarter to date right on, fiscal year date essentially right on at 15.4% versus 15.6% for its benchmark. Westfield, a strong quarter, up 13.4%, ranking really well at the 39th percentile. And actually, you look out longer term, it's outperforming its benchmark in all trailing time periods, ranking above median in all trailing time periods. So a really strong performer there, especially relative to the Russell 2500 growth index. And if you compare it even, to the Russell 25 index, right above it, doing even better there. Walter Scott was one towards the middle of the page that I mentioned at the top that was an area of underperformance. You can see it's good absolute performance at 9.7% for the quarter, but did trail its benchmark at 11.5%. This is one that we've taken a harder look at more recently. The performance, they don't have a lot of the Mag 7 in there. They do hold a few. They have Microsoft, they have Alphabet. They don't have things like NVIDIA, which has been a real market driver recently. This is one where we would hope to see it improve if market breadth expands. Just like we saw in January, and they did have a strong January, but saw some weakness in February and March, similar to sort of that dynamic in April versus May and June. So this is one that, we are taking a closer look at as a whole, as a firm, but something we feel comfortable with currently. And then the two new managers there, Impax and Lindsell Train. Impax, sort of two sides of the same coin here, with Impax being strong this quarter at 12.6%, outperforming its benchmark. Lindsell Train being a little weaker this quarter at 9% versus 11.5%. Lindsell Train, the difference there being it has that value tilt. So you can see year to date, Lindsell Train is still up 10.6% versus benchmark, despite sort of the underperformance this quarter. So both of these managers, performing in line with what we would expect, and no real concerns. And obviously, we're going to need a lot more performance there, some more history to sort of make sure that they're, continuing their investment philosophy. But right now, we feel comfortable with those two managers. At the bottom of the page, Silchester and Acadian. Silchester being sort of a single product shop, very intrinsic value bias. Their Q2 and year-to-date performance is up, so strong absolute performance, but they are trailing the benchmark slightly. However, non-US developed has really been the place to be year-to-date. You can see up 16.4% for the strategy and the benchmark up 19.4%. So strong performance has been added to the portfolio, all said and done. Acadian, this is one that we recently put in. So no performance here, but this is going to be pretty different from a lot of your other managers, being it is a quant manager. So nothing to really mention here. In July, it was in line. So we would expect, some outperformance to come from them as we round out the year. And then on the fixed income side on the next page, the goal here, as we've talked about, is just to construct a diversified portfolio and really outperform that Bloomberg US Aggregate Index. You can see this part of the portfolio is outperforming in all time periods. It's ranking well. You look out to the longest time period we have listed at 10 years, up 3% versus 1.8 for the benchmark and ranking in the 30th percentile. So really strong part of the portfolio. More recently, Fidelity has done well. It's just good not to be too long from a duration standpoint. Common Fund is one that you'll see that we're recommending replacing. And then BlackRock, SIO, and Bain have been two parts of the portfolio that added a lot of absolute performance. BlackRock being one that provides less correlated alpha. And then Bain, you can see longer term, that 3 to 5 years, really driving some of that performance at 9.1% and 7.4% respectively. Newton in the GA part of the portfolio, mentioned this being a little bit more defensive positioning. They did see some positive performance in their return-seeking core portion. So think things like long equities, options, renewable energy. They had some gold in their portfolio, which has been really strong. But that more stabilizing, that more defensive nature sort of was a negative during the quarter. They had some hedge positions, particularly currency hedges, derivatives hedges. So although good absolute performance, still underperforming a little bit when you think of it in context of the wider equity parts of the portfolio. Some similar comments can be made on Lighthouse just below it. Going to be a little bit more defensive. Long short manager here. They're ranking a little bit below median, but similar dynamics to Newton. And then Landmark. The one private equity, I would almost disregard the numbers you see on the page here, just given their time-weighted returns. And we have the page in the back that shows their IRR, their internal rate of return, which is a dollar-weighted return, up about 10.5% since inception. That's as of 3/31, which is going to be in line with other managers of similar strategies. So a few of the other managers that aren't in this portfolio that we can quickly hit on. In the pension fund, I think Baird and Principal. Baird being one that we're actually recommending replacing. Not from necessarily a performance standpoint. You can see they've done pretty well. You can see that 3-year number at 3.2% versus 2.5%. and ranking pretty well, but for some other factors that Kelly will talk about. And then Principal on the next page, outperforming this quarter of 1.8 versus 1, which is helping to bring that longer term performance at that 10-year you see up 5% versus 5.3%. So bringing that closer in line, just given some of the dynamics that we've seen in the real estate market, would expect some more tracking here with this manager. And then finally, I think the remaining manager in the operating fund is PIMCO. This is in line more recently, actually slightly outperforming its benchmark and outperforming in all of the longer time periods. This can be pretty different from peers. Most are going to have sort of a 60% equity, 40% fixed income. PIMCO is going to have less of that equity exposure, so it's going to fall below median, which is why you see some of that rankings more recently sort of underperforming, just given the strong equity markets, at least in Q2 and prior to that in 2024. But the hope is here that they're going to still provide you some absolute return, some diversification, particularly as it relates to inflation. Going to have things like tips, commodities, that sort of thing. Q2 specifically, they had some non-US equity stock selection, which was really positive for them, and then emerging markets debt, which was also positive. So any questions on managers before I turn it over to Kelly to talk through that fixed income recommendation? All right. Kelly, do you want to take us through that recommendation then?
I can. I think, Jack, I saw your mouth move. Did you have a question before you could get off mute?
Yeah, sorry about that. What proportion of the portfolio for equities and fixed income would you consider passive versus active?
Yeah,
given the constraints with the hydrocarbons.
So for the managed investment pool, Jack, we have 15% in SSGA, which is considered passive. And then I would consider this Fidelity passive at 15%, so that's 20%. And then Vanguard is passive as well. So about a quarter of the portfolio is passive in the managed investment pool. And then for the pension, it's 13%. We have Fidelity and Vanguard. So this is more actively managed. And then in the operating fund, I would consider all cash generally passive, right? So that's 30%. And that is it.
What trends do you see for endowments our size, and particularly ones with the twist with avoiding energy exposure?
Sure. So I would say generally what we advocate for is traditional large cap equity exposure and treasury exposure, generally to be passive, just because when you look at the universe of managers over long time periods, it's hard for managers to consistently add value. So I would say a number of our clients, when they go passive, those are the two most commonly used asset classes to go passive. And then I would say if there is a more focus on fees and reducing fees, also see passive across small cap, international, and emerging. However, those are areas where managers have tended to add value when you can select the right ones.
Well, and then one quick last question, I apologize, just my first opportunity to ask. What percent of the portfolio is limited partnerships, hedge funds and other investments?
So when you say limited partnerships, are you just talking specifically about hedge funds, or are you also considering like the common the commingled fund vehicles, like Acadian Emerging Market Equity is technically a limited partnership because it's a commingled fund?
Yeah, I guess. How about what percentage is hedge fund and what percentage is private equity or venture cap?
Sure. So on the managed investment pool here on this page, Lighthouse is the only hedge fund manager. It's a long short equity hedge fund globally. That's 7%. And
Okay.
Landmark has a 0% target, about $600,000 in assets, 0.2% of the managed investment pool. That is a strategy that was put in place back in 2014. It's a secondary manager. At that time, there was a big secondary opportunity. But the investment committee has steered away towards implementing a private market portfolio for a number of reasons.
Great. Thank you very much.
Yep, and then similar in the pension, Jack, just to round out the answer, Lighthouse is in the pension at 5%. That again, that's a hedge fund. And then in the operating pool, 5% as well. So only one hedge fund across the three pools of assets.
Perfect. Thank you.
Yeah, anytime. Thanks for the questions. Any other questions from the group before I switch over to the fixed income review? Okay. So the next few minutes we'll review core fixed income. Matt called out a few of the managers, one being Common Fund and the managed investment pool. It's a manager that you've had for a long period of time that manages towards the Barclays Aggregate Index. And then Baird in the pension fund and the operating fund, which again also manages towards the Barclays Aggregate Index. And as the committee works towards the goal of full divestment of fossil fuels by 2030, we have been working with you all to work towards that goal. And so as background, for all the equity managers across the three portfolios, there is no fossil fuel exposure as represented by the Carbon 200 Underground. And so now we're moving on to the rest of the portfolio, and the next area being fixed income. And there's not much exposure to fossil fuels in the fixed income managers. Really, it's just Common Fund and Baird. Because my earlier comments, we have U.S. Treasuries passively managed. There's no fossil fuels there, and then some Treasury inflation protected securities, which again, no fossil fuel exposure there. So it's really Common Fund and Baird. It's about $615,000 of total fossil fuel exposure as measured by the Carbon 200 Underground. So that's what we're focused on today. And we found a way to reduce that exposure down to zero. So what Matt and I did is we looked across all of our 1 and 2 rated strategies in the core fixed income and the core plus fixed income space. And the differences there is core fixed income just focuses on treasuries, mortgages, and investment grade securities. And core plus can go a little bit outside of those 3 areas and invest a little bit in high yield and other non-benchmark securities. So we looked at all those managers, and we looked at the managers of our 1 and 2 rated strategies that are able to take separate accounts at minimums in line with the assets that you have to invest. And the reason why we're looking at separate accounts, and we've talked about this before, is when you invest with a commingled fund like Common Fund today, or a mutual fund like Baird today, you cannot go to the investment manager and say, please exclude these securities from your portfolio. You need to have a separate account. And so we just looked at those managers that have separate accounts to fulfill the assets you have to invest in this area. And I'll go through the pages, but just to get to the punchline here, we are recommending that you consider IRNM Aggregate to replace both Common Fund and Baird for a number of reasons. One is this is a firm that's been around since the late 80s, founded in Boston by 2 gentlemen. They have $27 billion in this strategy alone, so very well used in the marketplace by institutional investors. And then their firm level assets are $125 billion. So very strong profile in terms of a firm. The team has been very stable with limited turnover. And when we look at performance, and I'll show you some metrics in a moment, very strong absolute performance, strong relative performance versus benchmark. And we look at it more on a risk-adjusted basis, or look at things like information ratio, which is excess return over tracking error, strong information ratios. Also looking for managers that can participate in the upside, but also protect in the downside when rates are going up. So this is a manager that has proven to be able to do that. We also look at investment management fees. IRNM has higher investment management fees compared to Common Fund, but lower than Baird. And so on a net basis, you'd be saving about $8,000 just on investment management fees, so comparable to what you have in place today. And then I think more importantly is you have IR&M today in the operating fund. You've had them in the operating fund for a long time managing a 1 to 3 year government credit strategy, so very short-term fixed income strategy. They've outperformed and they've been a good partner for you as that strategy is also in a separate account. And they were able to, one, divest from coal back in, I believe it was 2017, 18, when that requirement came about, and also the Carbon 200. So we know this is a manager that can successfully divest from those securities that you're looking to divest from. So in terms of just some details to some numbers to put towards those comments, I have Baird and Common Fund highlighted here. Baird has a 30 basis point investment management fee. Common Fund has 16 basis points. Seems relatively low, but just a comment there is Common Fund is a manager that invests in other underlying fixed income managers. So think of a hedge fund to fund, but in the fixed income space. So they invest in, Western Asset Management, PIMCO. I'm not giving the exact underlying managers, but managers like that. So you have fees from the underlying managers and then fees that you pay to Common Fund. So the fees are at an overall basis higher than these 16 when you roll up the underlying manager fees, but this is just quoted fee that you pay to Common Fund. And then down here, income research and management, 21 basis points. So as I mentioned, lower than Baird, a little bit higher than Common Fund. There's an asterisk beside it. This NAPC does our best job to negotiate fees with all investment managers on behalf of all of our clients. The stated fee for income research and management is 30 basis points, but we've negotiated them down to 21 basis points. So getting some fee savings there for University of Maine and other clients that are invested in this strategy. In terms of the product information, I mentioned earlier, it's been around since 1987, 121 billion in assets at the total firm level, and then 27 billion at the strategy level. It's 90% employee owned, so it's owned by the partners in the firm. The other 10% is owned by one of the founders, two of the founders' sons, as he was doing some trust changes and transferred his ownership to two sons that do not work at IR&M. In terms of performance, IR&M's this orange box here in the middle of the page. And if you compared their results over the trailing time period as of June compared to Baird, you can see that they're relatively in line with Baird. Baird does outperform a little bit depending on the period that you're looking at. They do have the capability to go a little bit down the credit spectrum, and that has added value over this trailing time period. But you can also see that IR&M has performed a little bit better than Common Fund. So net, if you kind of combine the two strategies that you have today in place, you kind of would be potentially going into a strategy that has comparable returns going forward. I mentioned information ratio. So information ratio is the excess return of the managers over the tracking area or the deviation over time of that excess return. If you divide those two, you get to an information ratio, and you want that information ratio to be higher, so meaning you're getting the returns with not excessive amount of risk. So in terms of the information ratio for IR&M, you can see, pretty strong positive information ratios, right in line with Baird that you have today, and better than Common Fund, which you have in the managed investment pool. And they're doing it with, very minimal tracking error, which is what you would expect from a fixed income manager, much lower than what you have with Common Fund and on par with what you have with Baird. In terms of upside downside capture ratio, looking over either the 3 or 5 year period, I'll focus on the 5 year period. IR&M participates in the upside, meaning when the benchmark is positive, 100% of the time, IR&M is as positive above that benchmark. And then the down capture, when the benchmark is down, IR&M tends not to be down as much as the benchmark. And those results are pretty in line with Baird. Baird has a little bit more up capture than IR&M if we look at past returns, and then more so than Common Fund. Common Fund actually is more of a downside protector and not keeping up with the upside as much. Couple other things that I wanted to know in terms of the strategy, and I'm just going to go to this next page here. You've noticed that I have two IRNMs in the presentation. Again, we are recommending the IRNM aggregate strategy. There is also the IRNM Core Plus strategy. Now, this is a strategy that is able to invest in out-of-benchmark securities such as high yield, bank loans, other types of securities. And we're not recommending the Core Plus strategy, even though the returns of that strategy look little bit better than the aggregate strategy. And that is because you do have the exposure to BlackRock and Bain already in the portfolio, which I consider return-seeking fixed income. And so just did not want to add any more to that. So just wanted to stick with the pure aggregate strategy. So did want to note that as well. So those were the key points that I wanted to make on the recommendation. I'll stop there and see if the committee has any questions or concerns on the recommendation.
Kelly, if we move forward with the recommendation, what is the time frame for replacement here?
Sure. So both Baird and Common Fund have daily liquidity. So the time frame can be as soon as administratively feasible. So given that IRNM would be going into a separate account, the documentation for that can take a little bit of time. Tracy and team has already been through documentation with IRNM for the operating fund for that short duration strategy that you have in place. So there could be a lot of overlap with it, making it a little bit more simple. But again, as administratively feasible to answer your question directly.
Thank you.
Any other questions from the group? Okay. Trustee Martin, maybe I'll turn it back over to you to read the action.
Excellent. Thank you. And thank you for your presentations. So tab 4, the core fixed income manager recommendation. I'll read the text of the proposed resolution that the Board of Trustees acting through the investment committee approves the following manager recommendations. For the managed investment pool, terminate common fund fixed income and replace with IRNM aggregate fixed income. For the pension fund, terminate Baird fixed income and replace with IRNM aggregate fixed income. And for the operating fund, terminate Baird fixed income and replace with IRNM aggregate fixed income. Any questions or discussion? Hearing none, can I have a motion?
So moved.
So moved by trustee Baldacci. Do I have a second?
Second.
Second by trustee McMahon. And Beth, please call, do the roll, the vote.
Yes, trustee Martin,
Yes.
trustee Worth,
Yes.
trustee Moore. Trustee McMahon,
Yes.
trustee Baldacci,
Yes.
trustee Moore, I didn't hear your.
Yes, sorry.
Okay. The motion carries.
Excellent. Thank you so much, Kelly and Matt from NEPC. Always enjoy your presentations and your commentaries on the markets and reviews of the funds.
Thank you so much. It was great to be with all of you today. Enjoy the rest of your meeting.
All right, we'll see you on December 11.
Sounds great.
Sounds good.
All right.
Thanks all. Bye.
Take
everyone.
care. And I see Barry and I see Mike joining us. So I'm going to hand over the meeting to Cap Trust to go over our defined contribution plans, market commentary, and emerging market recommendation, annual participation fees.
Okay, sounds good. Well,
Trustee Martin, sorry,
Yes.
Mike, I just wanted to make one comment. You said December 11, but not to confuse, it's now December 3rd for the next.
Oh my
investment.
goodness, I got it inverted.
Yeah, it's all right. I just wanted to
Thank
make
you,
sure.
thank you for that.
folks know.
I'm gonna have to go chase them and tell them I made a mistake on that one. I'll send
No,
an email,
I'm
but it's
sure
the
they're fine.
3rd.
I'll take
Thank
care of
you.
it.
all right. Well, it's great to see everyone this afternoon. And I think probably NEPC shared a lot of good news in terms of markets and performance, and we'll continue with that theme. It's really pretty much all good news today. Barry and I are going to go back and forth a little bit to try to keep this as interesting as possible. I'm going to start with just some really quick industry updates that we do think are important for the trustees to know about. And then Barry will go through some market performance, turn it back over to me. I'll go through the scorecard and talk specifically about the fund performance. And then Barry will wrap it up talking about an emerging markets recommendation and also some good news on the fee side. So I'll go through this. Let me start sharing my screen. But again, if you have any questions, obviously, just please jump right in at any time. So can everyone see that screen okay? Maybe just a quick thumbs up. Okay, thank you. So there's really some interesting industry updates here this quarter. And a lot of these are changes that we frankly kind of anticipated some of them with the new administration. A lot of these are being driven by the new administration. I won't go through all the details on all of these pages, but just some highlights here. If you look over on the left-hand side of this page, we're talking about environmental social governance, otherwise known as ESG, regulations or potential regulatory changes. ESG, otherwise known as socially responsible funds. This is kind of a regulatory pendulum that swung back and forth from the current Trump administration to the Biden administration, and now it's being revisited again with the current Trump administration. And basically, the first Trump administration really changed the regs a bit to make it more challenging, if you will, for plan sponsors to offer ESG choices. They're really very kind of a little bit negative on ESG choices, for lack of a better phrase. So they changed the language in the regs to make it more challenging for plan sponsors to offer those investments. When the Biden administration came in, interestingly, one of the first things that they did was to deem those ESG regulations unenforceable and said that they were going to come out with their own set of regs and making it, again, generally easier to include ESG choices in the plan. And then on May 25th, the DOL announced that they would be crafting a new rule specifically for retirement plan fiduciaries addressing the topic of ESG investment. One thing I just think is really important here from CapTrust perspective, we monitor and score the ESG choice in your plan and ESG choices in general following the stricter guidelines. And what I mean by that is we really look at them purely from an investment perspective. We don't take into consideration the fact that they're ESG choices. So when we compare their performance against their peers, for example, we're not comparing it against other ESG funds. We're comparing it against the peer group specifically that they're in. So nothing really significant here in terms of changes in terms of how we monitor, review, score the ESG choices. But I do think that, it's something that's important for people to know. The next one down also is another regulatory change. And you may recall cryptocurrency was in the headline. This goes back several years, again, during the Biden administration. And really, one of the triggers here is Fidelity came out with a statement that they were going to allow cryptocurrency in their 401k plans or on their 401k platform. The DOL, which they rarely do, kind of came out and made and addressed that statement. And they basically added some language that stated that fiduciaries should exercise extreme care before selecting cryptocurrency investments. And that's something, again, we've not seen that a lot with the DOL. They clearly, were wanted people to be careful before offering cryptocurrency. The Trump administration, the current Trump administration, is very pro crypto, as you've probably seen. I think they even have their own coin for that matter, but they're very pro crypto. And so they've directed the DOL to basically eliminate that language or rescind the guidance of exercising extreme care with regards to cryptocurrency. So again, just some changes in terms of the language and potentially to the regulations. From a crypto perspective, this is not an asset class that we envision in the University of Maine system core investment lineup anytime soon. We certainly tend to be more conservative on CapTrust. Maybe down the road, cryptocurrency might be very common in 401k and 403b plans, but we still think it makes sense to proceed with caution here before opening up a fund lineup to anything crypto related. So no recommendation here other than just to point out that it is something that we think is going to get more attention, but we certainly aren't recommending that you add any type of cryptocurrency investments to your fund lineup. I jumped ahead a couple slides, and I'm going to go back to the last slide, but it's kind of on the same topic in that the current administration, you may have seen a few weeks ago, is really wants 401k plans opened up to private investments. So basically private equity, private debt, private real estate, things of that nature. Private investments are something that have been available in the defined benefit pension world, endowments, foundations for a long time. You may even have some in the investment portfolio that you just talked about. That's not something that we've seen in 401k plans or 403b plans. But again, the current administration is really kind of pro-private investments. So we're seeing this get a lot more attention. There was a front page article in the Journal just a couple weeks ago about this. There's definitely some concerns with offering private investments in 403b plans. The valuation process, the liquidity of privates, the fees on privates. I mean, these are all things that really have to be looked at very closely before offering private investments in 403b plans. So kind of similar, our position here is similar to cryptocurrency, which is, yes, this may be something that's a common part of retirement plans and part of the Humane System plan down the road. But there's no reason, in our opinion, to take a leadership position on this and offer these types of investments right away. I do want to point out, though, that you do have a self-directed brokerage account, and people may have access to these types of investments, including cryptocurrency, through the self-directed brokerage account. We think that that's the most appropriate way for participants to access them is to do it through brokerage. And then also when you look at the private markets, these are things that we also, might start to see more exposure to privates in things like managed accounts, target date funds. You also already have kind of a flavor of it in your plan with the TIA Real Estate Fund. The TIA Real Estate Fund is really an investment in private real estate. So again, I think, there's a lot that's going to come out on this in the coming months and years. But for now, it's really just more informational than anything else. Questions on either of those topics at all? I did want to go back one page. There's another slide here, which I think is really important. Your plan is obviously a non-ERISA plan, so you're not required to follow ERISA, but you do follow ERISA as a best practice. And we really obviously think that that's a smart move in terms of reducing your overall fiduciary risk and frankly, just running a really good plan as you folks do. This slide goes through an Aon survey that was done on ways to mitigate fiduciary risk and ultimately reduce fiduciary liability insurance premiums as well. And over on the right-hand side of the page, you can see the things that is considered to be most important. Periodic fee benchmarks. This is something that we do on at least an annual basis for the Humane System plan. Barry's going to talk in just a few minutes about an additional rate reduction that we were able to negotiate. Retail share classes of funds. You folks moved away from retail share class funds several years ago. You don't have any retail share class funds, or for that matter, as we jump down, revenue sharing funds. We take formal meeting minutes after each one of these quarterly reviews. You do fiduciary training, and then we've talked about ESG investments and self-directed brokerage as well. Really, this slide is kind of a checklist of the things that you folks already do and already do right. And obviously that's important when following ERISA as a best practice. So again, just a slide that I thought was interesting to take a look at. The other topical spotlight slides, I wasn't going to spend a lot of time on today, but there is some interesting data in there that you may find interesting. And again, you can circle back with either Barry or I if you have any questions on that. But with that, I'll turn it over to Barry to talk about markets unless there are any questions on any of those topicals that I just covered. Okay, so Barry, just let me know what slide.
Yeah,
you'd like
you can
me to-
start here. I'll make my comments brief because I think NEPC already did the market overview, but my key, I guess our key themes for this most recent valuation is resilience in spite of chaos. And if you think about where we've been so far this year, this on again, off again tariff, the Liberation Day, lower valuations that have at least increased the opportunity set within the international market. A lot of activity, not to mention, some of the continuing wars in Russia and Ukraine. So in spite of all those things, we've seen a really resilient marketplace. Both the U.S. consumer continues to be resilient. You and me going out and buying stuff. If you probably noticed this morning, they increased the second quarter GDP from 3.3 to 3.8%. So in spite of all the inflationary concerns, we're still buying things. That really drives the U.S. market. But if you look at the performance here at the end of June, I did pull up performance through yesterday just to give you some idea where we are, throughout the third quarter thus far. The S&P 500, that 6.2% is now 14%. It's almost a 8 percentage point increase since the end of June. Developed international up 20, that's now 24. Emerging markets 15.6, that's now 28, primarily driven by South Korea, Brazil, Mexico, China. And then last but not least is a fixed income where we are up 4% as of the end of June, now up 6.6%. If we go to the headwinds and tailwinds page, Mike, and I'll probably stop here. Again, these are just themes in the marketplace we're seeing. Again, balance sheet strength, the U.S. consumer, the U.S. household continues to spend money. In fact, even this morning, there was a decline in first-time jobless claims. So really, it's making the Fed's more challenging in terms of forward-looking views on perhaps some interest rate cuts in the futures. So the market has reacted a little bit negatively today. Corporate fundamentals, balance sheets for the most part are very strong. When you see buyback programs, they tend to be when companies view that their stock price is undervalued. So we're seeing some stock buybacks happening. So all positive news with respect to the market. And then obviously AI we see across organizations, across the industry in the United States, people are exploring AI and how they can use AI in their business. So that's going to be a continuing theme for probably the foreseeable future. On the headwind side, or just this push-pull between the Fed and the new administration. The new administration clearly wants the Fed to be more aggressive at lowering rates. The Fed has been saying all along, we're not going to lower rates until the data suggests that we can. They did buck that trend a little bit in terms of lowering rates by 25 basis points last week. It will be very interesting if this data continues as it is, as we started to see come out. It's going to create some consternation whether or not they're going to lower rates at the next FOMC meeting. That's going to be something to watch out for pretty closely. We've seen housing. When you have 30-year fixed rate mortgages up over 7%, it tends to put a freeze on home valuations, especially in terms of people wanting to upgrade their homes. At the same time, we started to see the 30-year fixed rate mortgage last week went down to below 6.5%. So we are hopeful that they will unfreeze some of the housing market, but heretofore it's been a pretty frozen market. On the longer term detractors, again, sooner or later we're going to have to get more serious about our government debt, and both parties have been guilty of this, but sooner or later we're going to have to really get more serious, and it's a combination of things. It's not just tax increases for the wealthy, which certainly support that, but also entitlement programs that are going to be a third rail issue. But sooner or later, we're going to have to talk about all those matters. And then just the long-term impact of the aging population, as well as fewer immigrants with the new immigration policy. how is it going to impact the labor force in a go forward basis? Those are really more long-term themes, but certainly thinking about in terms of the next several quarters. But in spite of all of that, if you told us, at the beginning of the year we'd be up as much as we have, I would be like, you're smoking something. But really, we'll take the positive performance. You think about 2023, the S&P 500 was up over 20-some%. 2024 up over 20-some%, and so far this year about 15%. So really remarkable performance in spite of the chaos in the marketplace. We go to page 21, Mike, and then I'll probably turn it over to you after the next page. And this is our stair step in terms of the offerings that we offer plan participants in the plans, from the least risky funds to the most risky funds. Studies will say that when you offer too many funds, they tend to either not participate or go to the safe option. We think we have an adequate number of funds here to offer plan participants choice, but not necessarily overwhelming them with too much choice. And we think you've thread that needle in terms of how and how many funds we want to offer our plan participants. If we go to page 23, at the highest level, just where are the assets today? You can see in descending market value order, the largest asset class is stable value, which is really TIA traditional. We did freeze assets when we went to the group programs a number of years ago. That still represents about 22% of the assets. The target date funds represent about 18% of the assets, and it goes down from there. So, Micah, we'll turn that over to you on page 24.
Okay, great. Thanks, Barry.
Yep.
So again, just another snapshot of the funds, and what we do here is highlight the funds in terms of the asset totals, but then also where we do have funds that are marked for review. You can see we have 3 funds marked for review based on our scoring system. I'll talk about these in detail today. And then we have 1 marked considered for termination. Just a reminder, you've already taken action on the Euro-Pacific Growth, or UPAC as it's called now, fund. That fund was voted on to be terminated, and the assets are actually going to be moving into the MFS Intrinsic Value Fund, which is an existing actively managed international fund. So you really have 3 funds here that are marked for review. No concerns at all about any of these funds. And then this slide shows you just the frozen, Barry had mentioned that you still have a number of frozen legacy annuities with TIAA, and this adds up to, fairly significant amount of assets in your plan. These are funds that, certainly participants have the opportunity to move into the other choices if they want to, but that's a participant directed movement. And then I won't go through the next several slides in a lot of detail. It really just breaks down and gets a little bit more granular on what Barry just covered on a high level basis in terms of, where your assets are concentrated. You can see TIA Traditional obviously continues to be a really big part of the program at about 25% of plan assets. Vanguard target date funds, also a big part of the program. And, from my perspective, that's really good news. I'm a huge fan of target date funds. I'm a huge fan of the Vanguard target date series specifically. Interestingly, when Barry talked about his market commentary, it's certainly good news to hear the numbers that he threw out, 15% S&P, 25% developed international markets. That's actually particularly good news for the UMaine system plan, and specifically the participants in the Vanguard series. Vanguard has had a tactical overweight position to international for a number of years now. And, that position, while it definitely detracted a bit when US markets were surging, right now it's really led to some significant gains, both in absolute terms and in peer relative terms, with the Vanguard target date series. So just as an example, the Vanguard 2030 fund, that would obviously be a fund that's structured for someone who's targeting a retirement of 2030, you're going to have a lot more bond exposure in that fund. Again, because it's de-risked and gotten more conservative as people have gotten closer to retirement. In absolute terms, that fund is up about 13% year to date through yesterday, and it's beating almost 90% of its peer group year to date. So again, you think about a fairly conservative portfolio, which is the 2030 fund, up 13%. I mean, it just really continues to show you what an incredible year, and frankly, a surprisingly good year it's been in the market. The 2060 fund, which is obviously going to have a higher percentage in equities, geared towards someone who's, going to be retiring really 35, 40 years down the road. That fund is up 17% year to date, and also it's beating over 80% of its peer group. So, really good news from a market perspective, but really particularly good news, I would say, for UMaine system participants that are in those Vanguard target date funds. They've really had an exceptional year and frankly, coming off an exceptional year as well. So I'll go through these pages relatively quickly. Again, this was where we really just kind of break down the assets in each investment type, which Barry already went through at a very high level. From a scorecard perspective, though, things really look pretty clean for the most part. You can see there's a few due diligence notes. I mentioned that JP Morgan Equity Income is a fund that's marked for review, scoring on the low end of our scoring system with a 70. But we continue to really like this fund and the managers. They take a very disciplined approach. Really deep resources. The long-term performance continues to be sound. If you look at the funds that have been underperforming in the short term, domestically anyway, it's really been the more value-oriented funds. So JP Morgan, as we've talked about in the past, is really a deep value fund. There's not a lot of growth exposure there. And the result of that is that you're going to see really good downside protection from this fund when markets are down. So 22, when markets are down, this fund was in the top 20th percentile. All of a sudden, markets, roared back in 2023. And so we saw this fund down in the 87th percentile that year. And that's really a part of what's dragging those 3 and 5 year numbers down. Year to date, JP Morgan Equity Income is actually up 11.5%. It's in the top 40th percentile peer relative, which frankly, we feel really good about, considering we are in a growth-oriented market. Markets very, very briefly rotated back to value in the first quarter. This fund did very, very well in the first quarter. But then as markets, rotated back to growth, that's where we started to see a little bit of underperformance. Similarly, the Victory Midcap Value, you can see here, no issues. Overall, the fund is in good standing with a score of 86, but the 3-year peer relative performance is below the 50th percentile. And it's frankly very similar story to what we talk about with JP Morgan. It's a more defensive fund, a lower beta fund. It's a fund that did exceptionally well in 2022. It beat 90% of its peer group in 2022 when it was a down market. And then it lagged. It was in the 74th percentile in 2023 when markets rotated back to growth. So again, really similar story here. We continue to think that it's a good fund with good managers and a good approach. It's frankly just faced stylistic headwinds, with the exception of the first quarter of this year when we saw markets rotate back to value for a fairly brief period of time. But certainly no change recommendations for either of those funds. We continue to think that they're very good choices, very appropriate choices for your plan. CREF Social Choice, again, you can see scoring an 83, no concerns there. The 5-year peer relative and risk-adjusted performance is actually just slightly below the 50th percentile. This fund actually has bounced back incredibly well. Year to date, through the close of the quarter, it was actually in the top 2% peer relative. And I want to emphasize, when we talk about peer relative performance with this fund, we're comparing it to all moderate allocation funds, not socially responsible funds. So again, this fund's having a really good year. It's still in good standing, so no concerns here. And, again, we're scoring it by the more strict standards, comparing it to moderate allocation funds, not just socially responsible funds. If we were to compare it to socially responsible funds, it would look even better than that. So certainly no concerns there. Any questions on this page before I jump ahead? Okay. So Euro-Pacific Growth, you can see scoring a 61. I won't spend a lot of time talking about this fund since it is a fund that the committee has already voted to terminate. But again, UPAC is it's such an interesting situation. This has really been our top choice in the foreign space for as long as I can remember, really going back almost 2 decades at Cap Trust now. Euro-Pacific Growth, now the UPAC, has always just been considered top choice based on the depth of their resources, their low expenses, and frankly, their performance. Unfortunately, as you talked about last quarter, they're a growth-leaning foreign fund in a market that has really had a value orientation. Again, specifically, this is foreign we're talking about now, where there's been more of a value orientation for 4 of the last 5 years. So that's really caused underperformance. This is the second quarter in a row where it's been considered for termination. And we really do feel like that was the right choice for your plan. Year to date, it's up 23%. So, this is not a fund that's participants are going to be upset, based on the performance numbers. But to Barry's point, the EFI, or the developed market benchmark, is up over 25% year to date. So you're still seeing fairly significant underperformance relative to the foreign blend universe. MFS intrinsic value, very different story here. Year to date, MFS intrinsic value is actually up over 26%. It's in the top quartile peer relative. This marked for review. Again, my sense is probably as soon as next quarter, we're going to see that fund back in good standing. Even the numbers that you're looking at here, you're basically looking at one bad year that's caused that score to drop. So we continue to think that terminating the UPAC fund was the right choice. And frankly, we continue to think that, moving assets into the MFS International Fund was the right choice there as well. So, just kind of the near-term numbers certainly continue to validate that those were the right decisions. As we jump ahead, I mentioned Vanguard Target Date Series, really just having an exceptional year. You're getting, if you're in a Vanguard Target Date Fund, you're getting age-appropriate diversification, you're getting professional management, extremely low cost, and an automatic de-risking to your portfolio as well. So, we continue to think that the Vanguard series is the right choice for UMaine participants. And again, coming off a good year in 2024, and really across all of the vintages from the most conservative to the most aggressive, having an exceptional year this year as well. And a lot of that being driven by the tactical moves that their management team has made. I know that, it's an index-based series, and a lot of people think, oh, it's an index fund, but target date funds by nature, even index series, are still actively managed. You still have people that are making decisions about the glide path management, the de-risking strategy, the tactical overweight, underweight to whether it be fixed incomes or specifically international versus domestic equities. And Vanguard has really, made all the right moves, certainly in recent years. Both your capital preservation options, your Vanguard Money Market and your Tier Traditional, are in good standing, and you have a full suite of index funds, and you're in the institutional share class of all of these index funds as well, and those are all in good standing. So if you have people that really want to structure their own portfolio in the most cost-effective way possible, they can really do this using these 5 funds, we think, very effectively. I feel like I can't get through a 403B review without at least mentioning CIT legislation. I know we've talked about this the last couple of years. You folks are in the least expensive share class possible across all of your funds at this point, whether it be your actively managed mutual funds, your target date funds, or your standalone index funds. The next step to further reduce investment expenses would be to go to collective investment trusts. That's kind of the continuum that we see in 401k plans and have seen in 401k plans for years. The CIT legislation is still out there. It still is getting broad bipartisan support, and it still unfortunately just seems to be stuck where I'm starting to wonder if it's ever going to pass, which is really frustrating because as we've talked about, just looking at your plan utilizing the Vanguard target date series as an example, we could shift you to a less expensive CIT version of those and save another couple hundred basis points off the expenses. But we're lobbying for it. I know that almost all of the record keepers have been lobbying for it as well, but as of now, we're just not seeing any progress, unfortunately. And then finally, rounding things out, TIA Real Estate is marked for review. We continue to think that this is an appropriate choice in your plan. It's a unique investment. This is unlike, typical real estate investment trust funds. You're really a direct owner in TIA's real estate portfolio. And as we've mentioned in the past, unfortunately, that portfolio has a lot of retail and it has a lot of office space in it. And, it's very, very difficult to liquidate and restructure a portfolio like that. TIA is trying, and I think they're doing a good job with that, but it's going to take time. Just so the committee knows, we are putting together a meeting to talk to the primary manager on the TIA real estate portfolio, just to learn more. I know Tracy and Kelly are both going to be participating in that meeting to learn more about the portfolio and just to consider whether we should be doing something different in the real estate space for the Humane System plan. But at this point, we continue to have a hold recommendation on this fund. We continue to think that it's an appropriate, diversifying asset class for our participants. And we think TIA is doing the right things as far as, restructuring the portfolio as well. And then finally, CREF stock is in good standing, really just continues to do well. We score this independently as a distinct investment because it really doesn't fall into kind of a clean asset class. It's really it gives you exposure to large cap, mid cap, small cap, domestic equity, as well as some international equity as well. It's kind of meant to be a single choice equity holding. And as one, it actually does really well. TIA and the team does a good job managing it. We just break that out separately, and that fund clearly is in good standing. So overall, again, we think that the plan's in really good shape. You're having a great year in 2025 through the first now almost 3/4 of the year. And, coming off two solid years in a row in 23 and 24. And that's reflected in the boost in overall plan assets, and it's certainly reflected in the boost in participant accounts as well. So I'm going to take a pause there before I hand it over to Barry. Barry has a couple other topics to cover, but I just wanted to pause and see if anyone had any questions on anything that I covered before handing it back over to Barry. Okay. And Barry, do you want me to pull up the
Sure. Yeah.
the additional slide?
Yeah, please. As you probably suspect, we don't have a dedicated emerging markets fund in the portfolio today. If a participant wanted to get emerging markets exposure, they could get it through the UPAC fund. And they had upwards of probably 15 to 20% in any given time in emerging markets. But now that we have made the decision to replace that, the MFS International Intrinsic Value Fund has less than 5%. So we think it would be appropriate to offer an additional emerging markets fund. If we go to the next page, Mike, we're showing you two options here. Ultimately, our recommendation is to go to the Vanguard Emerging Market Stock Index Fund. Consider we don't have any exposure today. It's really more about the allocation than it is any outperformance. So consequently, we're showing you two funds, the Dry House Emerging Markets Growth, which is an actively managed fund, as evidenced by the fact that you have an expense ratio of 98 basis points, or the Vanguard Emerging Market Stock Index Fund at 13 basis points. They're both tracking the same funds. You'll notice the Vanguard fund slight differences in terms of the country allocations, et cetera, but it's an index product. So again, our view is if we want to get exposure to emerging markets, offering a low cost, well-rounded emerging markets fund with Vanguard. You can see at the bottom of the page, 5,000 holdings. So very, very well diversified portfolio within an index strategy. So net is we would fully support including a Vanguard Emerging Market Stock Index Fund in the portfolio for giving participants a choice if they want to get that exposure.
Any questions?
I might just say thank you. That's was a major concern of ours for all of our defined contribution plan participants when we not only had lost the originally dedicated the emerging markets fund, but then weren't able to. We were having trouble making the math work on the allocation targets after we lost Europac. So this is great to have.
Thank you for that, Jim. Any other questions, concerns? Hearing none, Barry, you're done presenting on
Yep.
emerging markets?
Yep.
Okay, I will read the text of the proposed resolution that the Board of Trustees, acting through the Investment Committee, approves CapTrust's recommendation to add Vanguard Emerging Markets Stock Index Fund to the UMS fund lineup. Any questions or discussion? Hearing none, can I have a motion? So moved by Trustee McMahon. A
Second.
Second by Trustee Moore, I believe.
Yes, sorry.
And Beth? If I could have
Trustee
you
Martin?
call.
I'm
Thank you,
sorry.
yes.
Trustee Martin, Trustee Worth, Trustee Moore,
Yes.
Trustee McMahon,
Good.
Trustee Baldacci,
Yes.
motion carries.
Thank you. And Barry, you're going to be discussing the good news?
Yeah, Mike, can you pull up just the agenda item summary? At the last committee meeting, we did, as we do annually, we did a fee benchmarking on the UMaine plan, more from the administrative fees that TIA is assessing plan participants. If you recall, a number of years ago, we went to a per participant fee. And so as a result of that, we still want to make sure that they're assessing fees commensurate with the marketplace. And so you asked us at the last committee meeting to go back and see if there's a way that we could negotiate a lower rate with TIA. Really good news in two ways. TIA was able to lower their fee from $49 a year to $45 a year. At the same time, you pay other administrative costs, probably primarily the CapTrust fee out of the revenue or excess revenue. So instead of us having to charge $68 a year to each plan participant based on because our fee is a flat fee, as the market goes up proportionally, there's less. It becomes less of a I guess the percentage wise goes down as assets go up. So if we're in a flat fee arrangement and assets go up, our proportionate fee is really going down. So in combination with that, so instead of a $68 per year fee, we are going to go to a $54 per year fee to each plan participant. So really good news in two fronts, lowering the TIA fee by $4 per year, but also lowering the overall charge assessed to plan participants by $14. Tracy, anything to add on that one?
Nothing to add, all good news. Thank you.
Good news. Yeah, very good news.
We love it. So Moving forward, I read the text of the proposed resolution that the Board of Trustees, acting through the Investment Committee, approves lowering the annual participation fee for the defined contribution plan from $68 to $54. You have any questions or discussion? Hearing none, can I have a motion?
So moved.
So moved by Trustee
Second.
Moore, second by Trustee Baldacci. And Beth, if you could take a roll, please.
Trustee Martin,
Yes.
trustee Worth,
Yes.
trustee Moore,
Yes.
trustee McMahon,
Yes.
trustee Baldacci,
Yes.
motion carries.
Excellent. Thank you, Barry and Mike. I think I love the description, resilience in spite of chaos. It's been a year, and
It's like,
anxious to see how we end up the calendar year.
for
So
sure.
anyway, thank you very much. Thanks to all who have attended, participated in today's meeting, and the next meeting, December 3,
December
right,
3rd.
Trace? Yeah. So I'll see you at December 3rd meeting, and I'll try to run down NEPC and give them the right date.
Thanks, everyone.
I'm reaching out to
Thank you
them
all.
anyway.
All right. Have a nice weekend, everybody.
Thank you.
Bye.
Take care.
All.
Bye.